Today we're going to talk about investments, so specifically this textbook, The Essentials of Investments by Bodie, Kane, and Marcus. We're going to begin to build a foundation that's going to improve your understanding and give you a much deeper understanding of investing. And one of the most fundamental concepts in investing is the difference between real and financial assets. Real assets are, as you can see here in this graphic, real assets are very tightly linked to items that have productive capacity, have the ability to produce something. And they include generally these areas here: property, plants and equipment, human capital. Really, the technical definition of real assets are any assets used to produce goods and services. So we have an offsetting kind of the counterpart to real assets is financial assets. And financial assets are the source of financing in order to invest in or to purchase real assets. So you'll recall from financial management classes that corporations are financed mostly with stocks, bonds, and preferred stock. Those are the three major asset classes. And those are all financial assets. And that is where the capital comes from for the company to invest in property and equipment, human resources, and that sort of thing. But maybe a concept that's even more real to you personally, to all of us in our personal lives, is having the ability to make an investment to improve our own fortune, right? Our own futures. So we need to understand just what an investment is and what it takes to get there. And I've told students for years that in order to increase your consumption in the future, you've got to reduce your current consumption. Most people live paycheck to paycheck, spend every dollar that they earn. They spend it on expenses. And there's an interesting little book called Rich Dad, Poor Dad. And in that book, the author draws the distinction that those that are poor spend all of their money. Those that become rich save some of their money and invest it for the future, because you can invest in financial assets that then pay you a stream of income and that grow in value. So in order to have the funds to invest to begin with, you've got to develop the financial margins, which means foregoing consumption today. You don't buy as big a house, you drive a car that costs less than you could really afford, and you save what's left over and invest it in financial assets. So that's where investment funds come from, and that's how wealth is grown. So looking a little bit more at real assets and financial assets, we have this balance sheet of all the assets of U.S. households, that's of individuals, put together by the Federal Reserve System for 2017. And you can see this is a typical sort of balance sheet. And we've got but it's broken down, the assets are broken down under real assets and financial assets. So it makes a distinction between the two and gives you the detail for each one. And then as is typical of balance sheets, you've got the liabilities and net worth on the right side of the balance sheet. At any rate, what's interesting here is that financial assets, if you look at this whole area under financial assets, you'll see things like bank deposits, corporate equity, so that would be common stock and preferred stock. We've got debt securities down here. There's your bonds predominantly. We've got mutual fund shares. Well, mutual funds are simply investment accounts that hold various types of financial assets. So the mutual funds may own common stock or debt or a combination. We've got pension reserves up here. Pensions are typically invested in financial assets. Life insurance reserves, life insurance companies invest in financial assets. So all of these, we've got right at 70% of total assets are financial, and about 30% are real assets. So 70% of the assets of U.S. households are financial assets that are invested in predominantly in companies, whether they're corporate or some percentage in non-corporate. These would be private companies, about 14.7% in non-corporate entities. But all of these financial assets are then invested in the productive capacity that's created by real assets. I didn't touch on a minute ago that the financial assets, so assets are owned, of course, by an owner of the claim. So the claim means the claim on real assets. So as a shareholder, an equity holder, stockholder, those investors that have shares have a claim on the assets of the company. They have an ownership interest in those assets, while bondholders have a claim on interest payments and repayment of the bond at maturity. So those owners own the claim, or these financial assets are owned by investors, but they are liabilities of the company. So these two things offset. For every dollar of stock that's owned, it is owned by a company, and every bond that is owned by an investor is owed by a company. So really, these two things wash out. They offset one another, so that in the end, after you offset those two, all that's left are the real assets. Once the financial assets and liabilities offset one another, we're left with the real assets. So that the domestic net worth of the country is the sum of all the real assets within that country. So in the United States, for 2017, what we're left with, as far as the net worth of everything in our country, is around now 67.8, let's say, trillion. Now, notice this is in billions, and you always want to look at the scaling. How many dollars? Balance sheets are often stated in thousands. This is in billions. So we've got 67,000 billion, which is $67 trillion, and it's broken down this way: residential real estate, biggest category, followed by commercial real estate. So these are productive assets that can produce income, right? So they are financial assets back them up, but they are the productive capacity of the country, along with equipment and intellectual property. And then we've got inventories and consumer durables. And again, this is all put together by the Federal Reserve. So financial assets are typically divided into three broad types. We've got common stock, which is equity, of course. We've got fixed income. So you're accustomed to hearing about bonds and preferred stock, and something they have in common is that both pay, or an investor would anticipate a specified cash flow, an exact amount that comes at spaced intervals over a specific period of time. So you think about bonds paying an interest payment every quarter or semi-annually or annually. Preferred stock pays a particular dividend, while common stock is a residual cash flow. So these common shareholders, which is the stock that you'd buy on Robinhood or at any stockbroker, typically most individual investors invest in common stock as far as equity is concerned. And common shareholders really get what's left over after all of your fixed income investors are made whole. So a third category or asset class is called derivatives. And you may have heard that in a negative light. It's this dirty thing. It's really not. It's a useful tool. Derivatives include, and we will be studying in the last week and a half of this class, options and futures, which are both derivatives. And you may know that options can be very risky. It's said that 90% of options expire worthless. You buy one and they become worth nothing by expiration. However, which sounds very risky. They can also be used, however, to hedge risk, to lower an investor's risk on their portfolio. So anyway, these are the three broad asset class categories. It can be broken down further, but these are the three main ones. So we're going to stop right here for this video. Keep these fairly brief, and we'll pick up the next section of this chapter in the next video. So I'll see you then. But before we go, I took a second and penciled out this in red on this slide. So this is really, here on the left side, is really kind of a simple sort of income statement. And it just shows that most people, middle class America, we work for a paycheck, right? And we do it so that we can pay our bills. So we're on this rat race of earning income to pay our expenses. If you want to build wealth, see, as we age, our physical capacity to work declines, right? Think of your grandparents. Probably don't do a lot. They're not able possibly to go to work, to earn, yet they may still have bills. And they do have some bills because they're still eating, right? Still have shelter, electric bills, and so forth. So in order to pay those expenses when you get older, today, while you have productive capacity, you've got to invest in assets that produce passive income. So these assets we're talking about are financial assets, stocks, bonds that pay an income, dividend-paying stocks. So as you age and your physical capacity diminishes, your balance sheet, your assets should be going up, so that at some point you have enough passive income to replace your physical capacity that you're now able to do. It may be that is why you chose to take this class. You understand that you can improve your future by becoming a good investor. So until next time, I want you to think about how to save money, invest wisely, and retire early. See you next time.